Title: Wells Fargo's Q2 profit skyrockets, interest rates and loan balances doing a money dance. TLDR: Wells Fargo's bag got significantly heavier in the second quarter as profits leapt 57%, thanks to higher interest rates and bulging loan balances. Wall Street had its bets, but the San Francisco-based bank beat their expectations with earnings of $4.9 billion. The cherry on top? Wells' net interest income did a 29% hop to $13.2 billion. But let's not forget the skeletons in the closet. They're still dealing with the fallout from their past scandals. Y'all crack open your piggy banks, folks. The second quarter has seen Wells Fargo's profits soar by a whopping 57% due to higher interest rates and loan balances. Who knew higher interest rates could be a good thing, for the bank that is? Strutting their numbers like peacocks at a parade, the San Francisco-based Wells earned a cool $4.9 billion or $1.25 per share, on a revenue of $20.5 billion. Those Wall Street analysts left in the dust. Their predictions were shy of the mark at a profit of $1.16 per share on a revenue of $20.1 billion. Remember this, kids, never underestimate a bank with a plan. Wells' figures have climbed the beanstalk compared to last year, when they brought in $3.1 billion, or 75 cents per share, on $17 billion in revenue. That's some growth spurt. And it looks like they're not the only ones cashing in. Other banks are also riding the wave of the Federal Reserve's aggressive interest rate hikes aimed at battling the big bad wolf, aka the worst inflation since the 80s. Speaking of interest, Wells' net interest income jumped up like a cat on a hot tin roof, by 29% to $13.2 billion from last year's $10.2 billion. Is this the new normal in the banking sector, or just a temporary sugar rush? But let's not forget, not all that glitters is gold. Wells has set aside another $949 million for credit losses, mostly for commercial real estate office loans and higher credit card loan balances. While we haven't seen significant losses in our office portfolio to date, we are reserving for the weakness that we expect to play out in that market over time, CEO Charlie Scharf said. Are they playing it safe, or is there a storm brewing? Here's a quick trip down memory lane. Remember those federal guidelines that came down on Wells like a ton of bricks in 2018? Those were imposed after a series of scandals, like the phantom checking accounts debacle, and capped their assets at just under $2 billion. Although this was expected to last a year or two, more improprieties came to light, causing regulators to question Wells' cleanup efforts. It's hard to sweep under the rug when the spotlight is on, huh? The bank's shares rose almost 3% in pre-market trading following the report. So, the question remains, is Wells Fargo the comeback kid, or will its past continue to cast a shadow? And will other banks follow in its footsteps or chart a different course? What do you think?